but we're going to go ahead and get started. We got a lot of items to cover, so welcome everyone. A couple housekeeping items, we'll jump right into it. You can submit questions via the question feature on the webinar control panel, as usual. If we can get to your questions, we will. If not, we'll try to address them after the webinar. So appreciate your patience with that. We will launch some poll questions throughout the webinar, so please complete these in order to get CPE credit for attending the webinar. The presentation slides can be downloaded from the handout section of the webinar control panel. And this will be recorded and sent out for on-demand access after the session. And at the conclusion of the webinar, as usual, we'll have a short survey that will launch, and it too will need to be completed for CPE credit, and certificates will be emailed in 2 to 3 weeks after the program. So today's topic on Star Wars Day, as you might have gathered if you didn't already know that, is the Employee Retention Credit Crackdown. So the IRS strikes back, and so we're going to jump right into it here. Welcome Jim Brandenburg to the presentation.
Thank you, Tom. Appreciate everybody joining us today here. We've got a lot of material to cover, and again, thank you for joining us.
So Jim, I'll let you kick us off here with the agenda, and we'll jump right into the content.
Okay, thanks, Tom, and thank you again, everyone. Again, here's the agenda of the items that we plan to cover today. Again, we're going to go to just a little background on the ERC, some of the changes that made it so much of an incentive and beneficial for companies, some of these third-party and other providers that got in the marketplace. Then we'll talk again about the IRS pushing back and some of the things that they've done and where that stands now. What to do if you've got a study, or either you're thinking of doing the credit or you've already done it with the documentation, and then looking at some other issues with the income tax and the statute of limitations, and then some expectations to look at for later this year and into next year. As Tom mentioned before, again, it's May 4th here. It's Star Wars Day, so we're going to have a couple references to that in the material. So you might enjoy that. If you're not a Star Wars fan, please bear with us on it. One of the things here, Tom, that we did was with the registration with it is just kind of pulse of some of the audience as to those who have actually filed a ERC claim, what level of assistance they got with that. So this is what we did get for those who had registered, for it.
Yeah, almost 50% used an outside vendor to basically sort of outsourced the service.
Right.
And then, 24%, probably consulted with one of their, maybe their CPA or another advisor, outside advisor to maybe a fractional CFO to help them prepare the claim. And then, about a fourth really did it themselves with no assistance. And by the way, Jim and I were reminiscing here. We're really a 3-year anniversary of the start of the pandemic, a little beyond. What you're going to hear today is that we expect the compliance activities to continue for quite a while here, and you'll see why when we get into some of the timelines and so forth. But as much as we'd like to think employee retention credit is something we can sort of put in the rearview mirror, I really think we're still going to be talking about this 3 years from now, to be quite honest. Right. I don't know, Jim.
Yeah, at least over the next year, we'll see what happens, but it probably is going to extend, I think for at least a couple of years with it, and especially if Congress may extend some of these statute of limitations with it. So. Okay, first we're going to just do an overview, and again, we've covered, ERC. Again, we've mentioned before, this is our continuing series, so we've done ERC on a number of occasions. So again, this is more of a, little of an overview, but we'll get into some of the recent developments, and again, talk on some of the IRS initiatives with it. Again, the ERC, this retention credit, was part of the CARES Act. Again, just a little more than 3 years ago, it was part of the COVID-19 pandemic, and again, it's a refundable payroll credit designed to keep people employed. And one thing that's a little different than the PPP loan that was also part of that CARES Act is this ERC is not like the PPP, which was excluded from income. This is one that's got to be pay tax on the amount that you receive with this employee retention credit. So one of the differences with it. Kind of the 4 steps that we talked about before with this credit to be aware of. Again, the first one is these affiliation rules to see if you need to look at this ERC on an aggregate basis with other related parties. The next one is step 2 is really the key one with it is, are you eligible for the ERC? And there's really 2 ways to get it. One, the first one is significant decline in gross receipts. Again, more of a objective test. The other one is this full or partial shutdown of the business or enterprise from a government order. Again, very subjective. We're going to spend more discussion with that on this government order during today's program. The next one, are you a small or large employer? And that would dictate that how much ERC you could get. In 2020, it was less than or equal to 100 employees. And for 21, it was less than or equal to 500 employees. Again, that measurement, though, is based off of your full-time employees back in 2019. And the last thing is, once you get over those hurdles that you're eligible and you find out if you're a large or small employer, then you go and determine how much ERC you can get. What you're looking at is, in 2020, it was $10,000 per employee per year at a 50% rate. In 21, much more higher rate, $10,000 per employee per quarter with the 70% rate. Again, that's in 2021. Let's move ahead here. I mentioned before that we're going to look at this government order here, and this is out of, we're going to reference this a few times today, is this IRS notice 2021-20 and these government orders. And what you're looking at here is, again, they describe, what's this government order here? And again, it's anything that limits commerce, travel, or group meetings for commercial, social, religious purposes due to COVID-19 and related to the suspension of the company or the operations of the enterprise or the business. Again, that's an important part of it. This is what's been out there. Again, very subjective determination available or that exists with it. Next slide with it. What you look at, that's a legal interpretation. Again, it's a facts and circumstances analysis. Again, each state, county, city, municipality, across the country during COVID had some of these different orders, various terms, various dates with them. And again, some cases, what we've recommended is maybe to get a legal opinion to say, what was that particular order and how did it affect your business? Again, some non-essential businesses might easily able to qualify, some hospitality industries, maybe healthcare ones. They had some elective procedures that were cut down. They could point to something in particular with it that they would qualify for. Again, you have in the materials and the resources this 2021-20 notice. There's quite a discussion in section C and D in there, both on this government order and this full or partial shutdown. So I encourage you to look at that, look at some of those questions, and look at some of the examples closely to see if you fall within there. It's a good discussion with it. They spend a good portion of that whole notice on. One thing to note with it is that this government order needs to have more than a nominal impact. And the IRS has determined that this needs to be at least a 10% impact with it. So that's something that you could measure in, perhaps in hours or volume that you have this 10% impact, on the business. Another one, next slide here, that has come up quite a bit in those looking at trying to rely on this government order to qualify for the ERC for the shutdown is this FAQ number 12 dealing with supply issues, that you had maybe a supplier that wasn't able to get you some products so that you might qualify for the ERC. And the IRS does indicate that you could qualify with it if that supplier had a government order that affected them and it was due to COVID-19 for that order that led to that. And so that's one that does address it here, but a couple things with it. The next slide here, Tom, that we wanted to point out with it, it's difficult for a company in some cases to document determine that they had a government order that affected them, that led to a shutdown. It's even more difficult, I think, to say that one of your suppliers was affected by a government order that caused them to, impact your business. How do you document that? Well, one thought we had with that is if you're trying to rely on this supply issue is to get a written letter from a supplier that states that there was a specific order that affected them due to COVID-19 that caused them not to be able to fulfill an order or a delivery of products to you, and that you were not then able to find those products from another supplier. So if you can get that in documentation, get that in writing, that may assist you in trying to, to fall under this supply exception. But again, it's difficult to document, what that specific order was if you're a supplier. Again, there's been a number of, businesses that have had supply chain issues. It's been in the news quite a bit, in the business news over the last several years. But the fact that you had some supply disruption, it could have been from a labor shortage, a strike, weather, equipment, whatever, but was it a government order related to COVID-19 that caused that supply disruption? That's what you're going to have to be able to document and show. Another thing that some have relied on or tried to use is to say, well, OSHA had some guidelines and guidance out there, the CDC did, and that's a government order, and thus nearly every business could qualify for ERC. And that's the assertion that they're making. However, the IRS is probably going to challenge that or not agree with that assertion. Our understanding is that there's some third-party ERC providers that have relied on this OSHA and CDC assertion to justify that the ERC for many employers. Again, that's likely one that the IRS is going to push back on and say that that was not a specific government order with it. So something to be aware of if you've had that in any of your situation.
Yeah, and Jim, I just throw in to your comments that we're trying to give an overview here of some of the more common issues that we see with customers that are looking at ERC, that are considering some of the reasons, some of the justification, and so we want to try to cover some of those. Because again, I think a lot of folks probably on this webinar are familiar with some of these.
Okay, good. Well, that kind of leads to the next one here, Tom. Is that here's some of the we put down here some of the comments that some businesses or employers have stated to say that they can fall into this government order, but then also some follow-up comments on it that state that may not necessarily be the case that provide you to be eligible for ERC. The first one is that, well, most employers in that industry qualify for ERC under that provision so that your business would qualify. Well, that's not necessarily the case. Each employer within an industry must evaluate the facts and circumstance, find the particular order in their situation, and show that they qualify with it. So even though there might be a number of others in the industry, doesn't necessarily even mean that your business does. You need to find that order, find out how that order specifically related to COVID-19 affected you, and then document that. Another one, you had a decrease in customer demand, that qualifies for the partial suspension. Probably not in that case. The IRS has indicated that if you've got a smaller demand, well, the gross receipts test that I mentioned earlier, that's supposed to capture in if you've lost some customer demand, that you rely on the gross receipts test, which again is a mechanical objective test. Some have said the stay-at-home order reducing customer traffic, again, is a government order that can use to justify it. Again, probably not in that case. Again, they're going to look to the gross receipts test. Or if you were forced for employers to go remote, you had a transition to go from the office space to a remote location, that does not necessarily constitute a partial suspension. Now, if the transition time to go from, if you were forced to go from the office to remote, and that took more than 2 weeks, let's say if it took a month or two to do that, you might be able to fall within that for that short time period, but not for an extended time frame with it. Again, it's a facts and circumstances analysis that you need to look at.
Oops, sorry about that. Hold on just a second, Jim.
No worries. There is, so one thing just to note that, you know, there's a risk with it if they go ahead and look to claim the ERC again, and especially if you're relying on this government order with it, that in some cases you might have, not only have to pay back that credit, but have interest and penalties. The CARES Act, however, provided that the Treasury Secretary will waive the penalties if you have a reasonable position. So again, one thing we wanted to point out in the seminar is that while the potential is that you have the credit, maybe some of it or all of it might be denied or disallowed upon audit, the question of whether penalties may exist, you know, would be another sort of a separate question. And again, the IRS, the Treasury Secretary, is supposed to have a reasonable review of that to see if penalties will be imposed. We'll have to see how that plays out as well once they get to those phases of reviewing those claims and the trying to impose penalties. Okay.
Okay.
Yes.
Go ahead.
I was going to say, with the initial changes that we had here, you know, what really expanded with the ERC, as many of you recall, was not only the initial CARES bill, but really CARES 2, which was right at the end of December of 2020. And what it did was, initially with CARES, you could only get the PPP loan or ERC 1, but not both. But this CARES 2 came along and said, no, you could get both. You could get both the PPP and the ERC. And both were permitted with it. You just couldn't take it on the same wages. So that's one thing to be aware of, is that you can't double up on the same and get a loan forgiveness with PPP and get ERC, but you're still entitled, or you're still available to get both of them if you qualify for it. The IRS does indicate, though, in this notice, again, 2021-20, that if you do have both of those overlap, you know, how to look at your PPP loan forgiveness, and then what wages might then be available for ERC. And that's one thing the IRS will look at if they come in and review your ERC, is separating out your PPP loan wages for forgiveness from your ERC wages. And they'll look at that closely. Again, this change in CARES 2 is retroactive. So that meant that there means that companies could get not only PPP in 2020 and 21, but ERC for both those years too. So it really opened up the opportunity for ERC, not only in 21, but looking back at 2020 if you qualify. And one thing that not only did they make it available for both PPP and ERC with it, but for 2021, the ERC was significantly enhanced with it. It was easier to qualify, you know, it was less of a threshold for gross receipts. This large company went up from 100 to 500. So again, when you're a small employer, again, you get ERC for all the wages, whether the employee is working or not. So much more ERC with that. The eligible wages is 10,000 per quarter, not per year. And the factor went up to 70%. So all of those items significantly enhanced the ERC in 2021 compared to 2020. So that led to, again, quite a growth in it. So when you look at that, again, the filing was easier with the ERC, the 941, or if you did amended return 941X, much less involved in the PPP loan application or loan forgiveness process that you had to do with the SBA. Again, the ERC goes through the payroll with the IRS. Again, once they saw this opportunity for ERC, a lot of businesses, even practitioners, would say we need some guidance from the IRS. And that came about again in March of 2021. The first guidance is 2021-20, provided us that guidance. So we got this change by Congress that expanded the ERC. We got some of that guidance. So we had this really significant opportunity available for employers then. Some went along and filed, you know, currently on their 941 quarterly payroll. Others then went back and filed on amended returns at 941X and are still doing that. And one other item to note that Tom and I were talking on is this sort of a small subset of the ERC is this recovery startup businesses that you can get the ERC with that started operations. This came out of the American Rescue Plan in March of 2021. Again, that might provide some ERC for Q3 and Q4 of 2021, but it's a smaller scale as far as what you're entitled to with that recovery startup credit.
And easier to, if you meet the qualifications, easier to qualify for.
Yes.
So, yeah. Okay, we got our first poll question here. Jim, you want to?
Question. Okay, we're going to talk about this in a little bit, but does your company use a professional employer organization, a PEO? Yes, no, or unsure. So that'll come up later on with IRS discussion on that, but we just wanted to get a flavor for those that use a PEO organization. So we'll give you a few moments just to answer that question. Okay, we'll be closing that poll in a minute here. Okay, let's look at the results with this first polling question here. Looks like we've got yes, 11%, no, 79, and unsure 11. So just a few that are using that at this point. Good, thank you for your response on that question. Okay, we'll turn it over to Tom now to talk about, again, with this growth in ERC, we've got a lot of third-party providers that came out there to provide some ERC assistance for a lot of employers.
Thanks, Jim.
Yep.
Yeah, thank you. We're here today because employee retention credit is still an ongoing topic. As you're going to see in some later slides, the IRS is talking about it, starting to audit, and there's still opportunity for folks to try to explore whether they can claim ERC. There's still time. So with all of that, we had a lot of entrepreneurs that came to see this as an opportunity, and a lot of consulting firms popped up across the country specifically to help with ERC claims. And so in a lot of cases, their fee structure was a contingent sort of fee, right? 15 to 35% of the amount of refund that they expected their clients to get. And in many cases, the fee was required to be paid when the claim was filed, which, as we know, many of you probably know that filed a claim. It took a while to get, and you may still be waiting for it, right? I know one of our participants is in the webinar. I think there's a comment, it's been 20 months. So you're going to pay that fee and then wait to get the refund. So, the other thing I think is notable here, and of course, we're too early in the compliance process to really know the answer to this, but when a firm charges a contingent fee, our experience with other credits, other tax credits, where this is fairly common practice, frankly, the IRS can, if they overturn the credit, right, disallow the credit, they can assess penalties, and because the advisor that was used received a contingent fee, this reasonable cause argument that we use many times to try to get the penalties abated is not allowed. It's not allowed because of the conflict, if you will, because the advisor is getting a contingent fee, so they're sort of sharing in the credit, in the benefit of the credit. So they're not considered to be an advisor that you can rely upon. So that's just something to note, that could come up in some form or fashion with employee retention credit. So, many of you are probably experiencing heavy volume of marketing from some of these ERC providers. There's letters going out. We've gotten some of these letters in our office, our clients have, where it looks very much like an official IRS letter or a letter from a financial institution. It's somewhat difficult for clients to sort of work through all this to figure out what's what's promotional and what's something they need to respond to. And so, the opportunity, as Jim mentioned earlier, as we know, there's really two tests to qualify. The first test is very objective, and it's based on gross receipts. The second test is very subjective, and it's based on this idea of a full or partial suspension of operations due to a government order, and therein lies where the opportunity is, because there's really a lot of interpretation. So the IRS has started to really chirp about some of these providers, and the term you see there in the last bullet point that is often used is they call a lot of these providers ERC mills, right? So they're just they're trying to be too opportunistic, too aggressive, and there's some concern out there. So, they push the envelope on their interpretation. They're very aggressive marketers. They do produce an ERC report or study. I've seen these reports. They're filled with, a lot of paper, a lot of documentation about orders, our understanding, and we're, again, very early in the process of our clients being audited, is that the IRS is, when they are performing an audit, they don't really pay a lot of attention to all of that paper. They want to get right to the point of which government order specifically impacted your business. So some things, to think about if you're thinking about engaging someone to help you, will they defend the ERC claim if audited by the IRS? Is that part of their agreement? Do you have to pay their fee up front, or can they defer the payment until you actually get your claim paid, right, from the IRS? If it's overturned partially or fully, if the amount of the claim is reduced on audit, will they refund some of their money? I mean, is that part of the agreement? There's a question: will they be around for 3 years or 5 years from now, when you potentially could be, you could have some open years there where you're subject to an audit, and will they still be in business? And I think the other thing is, this report they issued, does it have all the required documentation that would be needed if you were audited, right? These are questions I think you gotta ask your provider before you engage them. So what are the terms of the engagement letter? Mentioned, is there ability to claw back fees? Will they agree to provide certain documentation? We've got a checklist out there. I think it's maybe part of the documents that are posted here that you can pull down. But look at that checklist and see if they're willing to give you those documents you likely will need if you're audited. Ask the question if they've had any clients audited and what the outcome was. Review their claims and their marketing materials. I mean, there's a lot of claims out there that lead you to the conclusion that everybody qualifies, and that's just that's a little bit of an aggressive claim. If they're relying on the government order, the partial suspension rules, do they just blanket apply those rules across the entire timeline where ERC money is available, or are they really, which they should be, are they really looking at the time frame when the suspension was in place? And are they telling you that this is taxable? As Jim mentioned earlier, this is taxable. So if you amend those payroll tax returns, you've got to go back and amend your income tax return, reduce the wage expense, and so that's something that reduces the overall benefit of this. So I'll continue on here, and there's some, I guess, new, maybe not so new, but new entrants into the ERC marketplace that I think we should all know about. And those are insurance providers for ERC tax insurance. And then there's also providers that will actually advance part of your anticipated ERC claim. So let's talk about the ERC tax insurance. Why would you need tax insurance? Well, tax insurance isn't something new, right? If you know, a lot of large companies will buy tax insurance on a specific tax position that they took, just because you know, there's some uncertainty there. We see it a lot in transactions where you know, if there's certain reps and warranties that the seller will make, you know, the buyer of the company, you represent a certain things are or not, or you know, maybe maybe it has to do with tax returns that were filed in the past, and you can actually insure those reps and warranties by an insurance policy so that the seller can't get part of their sales proceeds clawed back, right? So this is not an unusual thing, and so it's now expanded into the ERC world, right? So in this case, we generally have about 10 very highly rated insurance companies that are willing to insure these claims. They got to be larger claims. They started out at 5 million. There are companies that will insure claims of 500,000 or above. There is some underwriting. The premium cost, right? So what's this cost you? Generally 3 to 6%, I'm told, but it can be up to 10% of the actual amount of anticipated refund. So there is a deductible. It's estimated at 5%, right? So if the IRS overturns your ERC claim, the insurance company would pay that claim, but subject to a deductible. I think there's the ability to negotiate that, but expect that there will be some deductible. There's also an underwriting fee. What's going to happen here is if you have a large claim and you're concerned, or you want to insure it, right, to sort of mitigate the risk of having to write a check back to the IRS. Again, uncertainty. Not saying that the claim is incorrect, but let's be honest. This is a new law. There's no court cases. There's guidance. It's good guidance, but we're a lot of really smart professionals are out there interpreting this, and frankly, until the IRS comes in and makes their interpretation, there is some uncertainty. So the underwriting fee will cover the insurer assessing the validity of the claim, the propriety of the claim, making sure that they understand the risk, and so they may charge you an out-of-pocket cost to just do the underwriting. So you can purchase the insurance at any time, even prior to actually submitting the claim, and the insurance usually will cover all costs, including attorney fees, to defend the claim, to go to tax court, and even will pay the tax costs if the claim is overturned. Generally, insurance in effect for 7 years, which should cover, even if there's a substantial understatement of income. The underwriting part of it generally requires a legal opinion. And there's an overall sort of document review package that's submitted to the insurance carrier. I think this is a really, the third bullet point, I think it's really something to pay attention to here, because I think it probably follows somewhat of what the IRS is thinking. Where's the risk, right? Where's the risk? Well, some states were more restrictive than others, right? So the idea that a government order actually impacted a business, I think there's less risk of that being overturned in a state that was much more restrictive, right? The industry, the employer, right? The employer that got the ERC claim, certain industries, hospitals, restaurants, workout gyms, retail, you know, that there's certain industries that are less risk, perceived less risk. You know, higher risk probably comes from, you know, manufacturing, construction, you know, essential businesses. So, and then the size of the claim. So, these are sort of new players into the marketplace. The other sort of new player here is you can actually get an advance on your claim. Okay, so they'll factor your claim, and you know, only applies again to larger claims. They will do some due diligence. Generally, it's about you'll get about 70% of the claim if you're approved up front, and then a second payment, right? So they will discount that somewhat, but there are vendors out there that are willing to advance those dollars for those that need the cash flow. So Jim, I'm going to give you the honor of talking through this example. This is where the Star Wars comes into play here. So this is Jim's, you know, this is Jim's pride and joy here. So Jim, you want to take us through that one?
Well, thanks, Tom. And Tom, as he covered here, again, we talked about the insurance and also this factoring here. So we just put an example, just the amounts. We've got R2D2 company that filed its amended return with a $500,000 claim. And in this case, it used Darth Probator to handle the ERC claim for it. And Darth charged a 30% fee for it. R2D2 then went out and hired C3PO Insurance, paid a $50,000 premium for the claim coverage, and then used Obi-Wan Financial to factor that claim and paid a 15% discount fee for it. So anyway, with this $500,000 claim, as you can see, you know, there's $150,000 going over to Darth Probator. We've got, you know, $50,000 for the insurance premium, another $75,000 went to Obi-Wan. So we're net down to $225,000. So more than half of it is lost in some of these fees. And then again, one of the things that we've talked about, and we'll talk about a little bit more further, is again, when you get this ERC claim, that's going to be income to you, you know, for the amount. In this case, it's going to, we put a 40% tax rate in with it. You know, maybe it's more, maybe it's less. So I came up with $90,000. So at the end, R2D2 is left with $135,000, about 27% of what they started out with. Again, if they wanted to factor it and get it right away, and if they wanted to insure with it, again, Tom mentioned, and we've got included in the small print there again, if you've got an underwriting fee and some of these other things that could change a little bit. But I guess the point is that if you do use some of these other services out there, it's going to obviously reduce the amount that the company is going to get. In this case, R2D2 would get quite a bit less. If it handled all of it themselves and didn't use any of these other services, they might not have got the claim, but as much of a claim perhaps, but again, only would have had to be concerned with the income tax part of it. So you're always going to have that amount that you've got to do. And again, that income tax needs to go back to the year that the wages were incurred, not when you actually receive your ERC refund. So just make sure that even though it might have been a year or two before, you've got to go back in, reduce your wages, increase that taxable income back to the year for those wages.
Yeah, and we left a couple of, you know, some of the costs that I mentioned, deductible costs, underwriting fees, we did not include in here. But, you know, the question really becomes, you certainly can buy insurance. It to some extent can lock in, you know, or mitigates the risk to make sure you know kind of what your net number is. So it might be the right business decision for some. So, Jim, you want to take us through the poll question? We're talking about all the marketing going on right now.
Yeah, with their second polling question here, again, as Tom said, there's a lot of these firms out there that are, you know, sending out their mailings or phone calls with the big TV and radio commercials too. So in 2023, how frequently have you been contacted by an ERC provider? And your choices are daily, weekly, monthly, or maybe you have not been, so never. So if you could take a moment and respond to that polling question. So again, it's not a day goes by, it seems like you're not hearing something on the radio or a TV or get something in the mail with it. So, okay, let's see a response here. Look at the interesting here. We've got daily, 16%, 40 weekly. So almost more than half of the respondents here, Tom, are getting at least once a week. They're getting something. Another third getting at least monthly. So
it's a lot. Yeah.
Quite a bit that are getting, have seen this in one form or another. Different types are getting, peppered with that. So, okay. Well, with that leads kind of into our next thing is that, again, we've seen all these claims. There's all the potential out there with the expanded ERC. The IRS has been, deluged with a lot of these claims over the last couple of years, especially once we got to the changes in 2021. Claims even continued to be filed, even as they had initial backlog, in 2021 as they were coming out of the pandemic. There's still, the backlog back then, back in, 21 and into 22 was probably 8 to 12 months. It has come down some, but they're still getting more claims in there, so there's a steady rise of claims that are coming in there. This last busy season, the IRS, had some of their resources over to help with the tax processing. Now they're going to get back and try to get in to get some of that backlog down. We got a slide here that pulled together that kind of shows back into the middle of 2021 up through a good part of 22. These claims as they rose in 21 came down some, but then again have started to elevate here again in 2022 here. And you can see all the claims that are sent out there, for the IRS. And again, once you get past, you get into 2000, at the end of 2022, you're starting to get claims that, are going to be 941X, these amended filings with it, not the original filings. And so there's a lot of activity with it, but it hasn't gone away. It continues to, be with the IRS. Here's just an update here. This was in just about a week and a half ago with the IRS. You can see they've got $350,000 of the regular 941s that they're doing that are unprocessed, but about $1 million of the 941X, which is the amended ones. Now, I did see the IRS commissioner mention that they have made some backlog just even since this came out. They're down, in the 800,000 range. But at the same time, they're reducing their backlog. They're getting more claims being filed. And most of these are being done in 2 IRS sites in Cincinnati and Ogden, Utah. So, and it's also not sure exactly, as Tom and I talked, how many of those are for ERC and COVID. There could be some other, amended 941Xs that, so not necessarily all of those are ERC related. What the IRS is doing is really a multi-pronged, assault that they're doing with this ERC. They were obviously aware of the surge of these claims, and they had a task force. They started last year in 2022. They trained a number of their agents, over 300 agents, to audit this. The audits began, late last year, and with this initiative, they're looking for, with this, that, with the statute of limitations, they may go to Congress maybe to extend the statute of limitations with it, but they have started with some of their audits on that. Next slide here, Tom. One thing to note is, again, as they're going through that, one of the things that they have found is in some cases there have been abuses with it, fraudulent activity. Just this February here, they had the IRS criminal investigation and Justice Department indicted an ERC mill in Utah. It had, again, over 1,000 fraudulent Form 7200, 941, again, with ERC and FFCRA credits, over $11 million. So, again, there were a number of acts that they had with this, and these ones were, I would think, even beyond, exaggerating the government order. These were just some cases of fraud that were involved with it, but it shows that the IRS and the, even in this case, Justice Department is aware of this and is looking for situations that were abusive with it, and they will respond and act accordingly on that. The other thing that they've announced here, and we've got a couple of these slides here, is that they've made at the end of last year and starting here in 2023, some publicity and some marketing campaign to let people know that there are some abuses out there, some promoters continuing to push the ERC to companies that may not be entitled to it. You got a quote here from the, at that point, acting commissioner. While there are legitimate credits out there, there continue to be promoters who aggressively mislead people and business thinking that they can claim these credits. And so that's one thing that they mentioned. And if you note at the beginning, they said the IRS and tax professionals see these third parties. So even some CPAs are sort of caught in the middle here because their clients are getting these promoters coming to them asking for it. The CPAs are looking at it, so we don't think you qualify, and get this situation where the CPA is caught there with looking at what the rules are and what these promoters are trying to push on some of the companies that they think they qualify for the ERC. And that's what the IRS is alluding to here with some of their announcements. And another one, next slide here, is this annual dirty dozen list that the IRS has. And these are some scams that are out there. It might be email things or identity theft that they promote each year, some things that the IRS says. They do it often during the tax filing season to make people aware of certain items. Well, this year, number one on the list for this IRS 30 dozen was the employee retention credit. And again, we took an excerpt from this that came on March 20th that talked about this. And it highlights a number of ones, but in this case, the ERC was in there. And again, we have a quote from the now current IRS commissioner saying, there are many cases where they're aggressive with it. And even in some cases where those who are promoting this credit aren't even letting the businesses know that they have to pick these amount up in income and pay income tax on that. So they're just saying, file and get this ERC and don't let them know that there's an income tax element with it. And then another take that the IRS is having is, using this, what they call the Office of Professional Responsibility, OPR, is an important thing for tax practitioners, CPAs, tax attorneys, enrolled agents, and others who deal with the IRS. They've got responsibilities under what is referred to as Circular 230 dealing with tax practice. And that also applies to the ERC. And the IRS made this announcement, this alert on March 7th, alerting professionals to that. That they need to use due diligence if they're involved with this, and that if they don't think these credits, falls or is one that they would agree with, that they need to, in some cases, let the client know that if some other party went and filed that claim for them, to let them know that it may be in error and that they may have some penalties that could be associated with that. And that in some cases not be involved in doing any tax returns for them. So again, I refer to that if you're a CPA with this, look at this alert that came out on March 7th dealing with exposure there. Another thing that came out earlier this year too was an alert. This was not from the IRS, but it was from a major CPA malpractice insurance carrier. Talked about some of the exposure with ERC claims that companies may have filed for this. And they may have some exposure, and that exposure could not only be to the company, but potentially to the CPAs there. So again, I caution CPAs in dealing with the ERC, to make sure that they're thorough with it, to make sure they get engagement letters, have discussions with clients on it. And again, if you haven't had that discussion with your carrier, if you're a CPA, that'd be something that you may want to do. So again, that's something, another angle with this, the exposure that lies out there. And the last thing we just wanted to mention here with it deals with professional employer organizations, PEOs, that Tom had mentioned before with it. And this was just about a month ago here. And it was an IRS chief counsel letter from a member of Congress who sent this to him that was actually last year and was just released in March. And again, these PEOs do the payroll on behalf of a number of companies. and they wanted to know, well, if they had ERC, how would that be affected if they had a PEO? And yeah, I bolded a little bit, a couple items from this chief counsel letter. When an employer used a PEO to pay that, the employment tax, the PEO is the taxpayer with the IRS. So just be aware of that. They're going to look to the PEO if they're handling your payroll claims, and then how the PEO disperses that refund to its clients is a contractual matter between the PEO and its clients. Okay, so the IRS isn't worried about what the PEO does. They're just going to deal directly with the PEO. PEO then needs to deal with this with its clients. And then this letter closes on the next page here that the IRS process an ERC claim. The PEO is responsible for making sure that if the client received that, that comes from the PEO, gets that to them. So it's not the IRS to get that to you, it goes to the PEO. But the IRS notes here in the next section that in accordance with their liability, the IRS looks at the PEO and the taxpayers being responsible for that ERC claim. So if that's invalid, they're going to look to the PEO as well as to the company with it. So something to be aware of if you are using PEO. Find out what the responsibility is, what your agreement is with them. And if you are a PEO, just be aware of the responsibility you are taking on by doing these ERC claims. To look carefully at that agreement that you have with it and what you have with any of your payroll customers.
Okay, thanks, Jim. We've got, we're running out of time here, and I'm going to blame Jim because, he's just, no, I'm kidding. We've got a couple really important sections we want to cover, so we're going to try to end on time, and I might, consolidate here a little bit, but a couple things we want to make sure, we've covered some of this already, right? You got to have the documentation. The substantiation is a term that you'll see in some of the guidance to support your claim, right? I think there's a lot of the promotional materials you see out there, they give you this broad brush, the entire industry qualifies. That's not true, right? You have to support your claim. And if you use an outside provider, they need to provide you with their work papers or documentation. Some questions, right? I mean, there's some risk here, but the fourth one down, do you need to aggregate the business? I know we have some questions from some of our attendees today. One of them is on aggregation rules. The answer is it depends, and they're complicated, right? And we'll try to, we're probably gonna have to address those after the webinar. But make sure you look at commonly controlled businesses. Make sure you look at the fact that you don't double dip. If you got forgiveness money that covered some of the wages, you can't use those same wages. So you got to have the substantiation. And I'll keep sending you back to, we have a checklist out there, but there's a lot of good practitioner content out there that helps you to understand what you need to keep in the file in case you're audited, right, to support your claim. So, some questions here, you can kind of look through these on your own. You've got a copy of the slides. We mentioned earlier, you've got to amend that year's return. If it's 2020 or 2021, you got to amend that year's return for the credit, right? So we mentioned the checklist. I'm going to kind of jump over this one. Again, the real gray area here is how is the IRS going to interpret this idea, this partial or full suspension, and do you have the government order? Can you tie all of that government order back to how it impacted your business? Did you comply with the government order? And do you have evidence? So these are important things. I mean, there's a lot of money that was dispersed here. And if you can't support your claim, you might be vulnerable to have some or all of it clawed back. So, should you get a legal opinion? Should you get an independent review of your documentation? That's a decision you need to make if you really can't substantiate the claim right now. I think there's, the IRS preferably would say you need contemporaneous substantiation. you know, I would tell you that it's never too late to try to you know, support that claim. Income tax considerations we've covered. This is the only slide in here on income taxes, but you know, the point is you've got to amend that income tax return to recognize that credit that you have received or will receive, and it goes back to the year of the wage expense. So make sure you understand that, you know, if somebody tells you you're going to get $200,000 of an employee retention credit, that there's a tax cost to that most likely. Right?
And the IRS is aware of that, Tom, that they're watching that closely to make sure.
Yeah, we expect that they're matching those up. So if taxpayers aren't amending those returns, I think you'll probably get a notice at some point.
Okay, our third polling question here, we'll make this brief here. Again, Star Wars theme here, which Star Wars characters would you take with you in an intergalactic battle? We got Luke Skywalker, Princess Leia, R2-D2, and C-3PO. They're the tag team together. Chewbacca or Darth Vader. So again, if you could indicate who would you would take along with you, we'd appreciate your comments with it here. I know there's other Star Wars characters, but we had to limit it down to 5 here. Looks like Luke's up at the top of the list with Princess Leia here. Oh, Chewbacca's second, so close race here. So, and R2-D2 and C-3PO a little further down. So good. Thank you for your responses here.
Yeah. All right. So listen, the last piece of this is, and I think it's important, and I'll try to get to a couple slides. The statute of limitations, right? So, you know, there's some promoters out there who, you know, are saying things like the money's going to run out or time's going to run out. Well, the money's not going to, this is not like PPP where there was a specific appropriation
Right.
and the money did run out, right? And as we might remember, that isn't the case, but time can run out, right? The statute on the 2020 tax year will expire on April 15th of next year for those payroll tax returns or amended returns that you might want to file for 2020. So, you know, as we sit here, we got, you know, 11 and a half months ish before that statute runs, and then 2021 is a year later. So they're all treated as filed. The statute runs for all those quarters on April 15th the following year. So so just know that you know that's coming upon us for 2020. You know, statute of limitation for payroll tax claims. The American Rescue Plan extended the statute from 3 years to 5 years for claims filed for the third and fourth quarters of 2021 only, right? Only, right? So if it was filed for third quarter of 21 or fourth quarter of 21, which would only have been for the recovery startup business, that's now on a 5-year statute. So it also applies to assessments, not to refund claims. So it did not extend the statute for you to go back after more than 3 years and try to file a 941X for a third or fourth quarter. It doesn't work that way. It's only for the IRS benefit to try to claw back some of those refunds. So you know that the statute runs 3 years from when the tax return is filed for refund claims. Okay, so and that's the same time for the IRS to make sort of make assessments. I'm going to jump to the last slide here because I want to talk about this idea that you know that the statute may expire. So if you file a refund claim this year for 2021, there's an additional 2-year statute from the date you receive that refund. Okay, so even though the statute runs for in my example, a 21 claim would expire in 24, because you took receipt of a refund, you've got another 2 years. and potentially 5 years at the bottom if the IRS determines that that the refund claim was induced by material, misrepresentation of fact or even fraud. Now, that could be misrepresentation of fact not by you, but potentially by the vendor that you might have used to help you with the claim. So the general point of this is that there's other statutes out there that may extend the time that the IRS would have to potentially claw back some of the refund claims. So there's as you can tell, there's this in this slide just this erroneous refund statute, but there are other statutes. I kind of jumped over those last few slides to get to this, but please be aware of these other statutes. And I'll also tell you that it's possible that Congress may extend some of those statutes. So Jim, do you want to wrap us up here?
Yeah. So again, we apologize with the going through those, but those are some important statutes, statute limitations to watch. Again, ERC developments this year to look out for. Again, the IRS is going to continue to warn taxpayers about that, continue their audit activity, which again should pick up this year and into next year. So be aware of that. It's uncertain if they're going to issue any more guidance with it, so it's something we'll keep an eye on with it. And as Tom said, there hadn't really been anything that's gone to court yet with this ERC. That could happen. That's probably maybe a year or so away before we get there. And then lastly, with Congress may pick up, they may get asked to, put this 5-year statute on all the periods, not just that third quarter of 2021. They may extend that. They may expand maybe some of the penalties for some of these abusive situations. So something to keep an eye on to see if Congress does anything with that. So last slide here, just to let you know, we do have some resources. Those top 3, I think you do the control, you'll be able to get those, our decision tree, our comparison chart, and our documentation checklist that Tom mentioned. Very helpful to go through that, whether you have a study or not, to gather that. That should, be very helpful with you if you get an IRS audit. And then the last is some of these IRS notices that have been out there in 2021 and one in 2023 that we've attached right in your resources right now. So again, we thank you very much for joining us with us. As Tom mentioned, that you will get the CPE certificate with it in roughly 2 to 3 weeks. We do have a survey on that at the end, so please review that and answer some of the items related to that survey. Again, we appreciate your patience with it. We appreciate your attendance at our session. And again, as Tom, we talked about before, this will be a continuing series. There'll be more on the ERC later this summer into next year, even with it, as the audits come along and some of these other developments. So we thank you very much, and thank you for joining us. We appreciate it very much.
And I'll just end with this closing comment. What do we expect for the rest of the year? We expect IRS activity to pick up. We expect to hear more about that. I would think by the end of the year, we're probably going to see some news reports of more ERC claims being denied, IRS or IRS criminal investigation action. And with all of that, I think then we'll see potential congressional action to extend the statute. All these things remain to be seen, but just remember the statute isn't going to run out tomorrow. If you are compelled to file a claim because you believe you have a reasonable argument, you still have time. You still have time to kind of watch and see what happens. So there's a lot of aggressive marketing going on out there right now. But I would just tell you to be patient. Let's see how some of these arguments play out. And again, as Jim said, thank you very much for your time, and we'll probably see you again with another update in a few months. Thank you very much.
Thank you. Have a great day. Thanks.